Markets shut down, monitors are black, spot is stuck at 79.25 fiat. Normies think it's quiet, just nothing happening out there. It's a long weekend. The riggers should be sleeping offline, totally out cold. Yet behind the curtain, nobody is resting. This is pure, raw panic. When a monetary metal like silver rips 10% higher in one trading session, the issue isn't just price action. The real issue becomes survival. Deep in Lower Manhattan and deep within the Federal Reserve, beast crisis talks are active right now, not because the rig is robust, but because it's trapped. A 10% rip isn't just a trade, it's a total solvency event. It shatters risk models, it destroys margin logic. Crucially, it imperils the one pillar holding this paper scam together, the central clearinghouse. When leverage hits volatility, the math quits being theoretical and starts becoming lethal. Banks don't swap silver with cash. They trade with debt piled high on top of more debt. 20-to-1 leverage, maybe 50-to-1. In quiet times, this mints easy fiat. In a violent squeeze, it completely detonates their balance sheets. A 5% rip against a naked short kills all equity. A 10% move doesn't just sting, it deletes your existence. That is why this weekend is key. If a bullion bank can't meet the call, when the market opens, the clearinghouse has to step in. If that house can't eat the massive loss, the whole Ponzi freezes. This isn't speculation, this is basic market structure. When the structure starts cracking, the elites don't ring a bell. They don't give warnings. They meet in the shadows and find ways to rig the rules again. You aren't seeing confidence, this is damage control. This chapter covers why these emergency meetings happen, why they always occur on weekends, and why they signal the system has lost control. If you want to understand what may happen next, you need to understand this critical moment right here before the open. If this deep dive helps you see the rig more clearly, subscribe to the channel and comment one below so I know you are following this series closely. To understand why these emergency meetings always happen on weekends, you must understand leverage. Not the buzzword, but the raw math that sits underneath the whole financial system. Banks and big funds do not trade silver using their own capital. They use borrowed fiat, rehypothecated collateral, and assumptions that volatility will stay contained. As long as prices move slowly, the rig works. It looks stable. It looks intelligent. It looks controlled. However, leverage is asymmetric. It rewards calm and punishes chaos. A trade leveraged 20-to-1 can survive small fluctuations and still yield steady profits. But the moment the market rips 5% in the wrong direction, the entire equity cushion is gone. There is no gradual bleed, there is no recovery window, there is only failure. And when silver moves 10% in a single session, the math stops being negotiable. Right now, any entity that was short silver with leverage above 10-to-1 is on paper insolvent. Their equity has been vaporized. They owe fiat they cannot produce. Under normal circumstances, the response would be simple. Issue a margin call, force liquidation, close the position. But markets are not mechanical when the counterparty is too large to fail. What happens when the losing position belongs to a systemically vital bank, or a massive industrial hedger, or another financial institution tied into the same clearing network? You cannot liquidate them without detonating the rest of the market. That's when the phone calls start. Regulators are alerted, central banks are looped in, the lingo shifts from trading to stability. This is why the weekend is key. Markets are shut. Prices are frozen. Time is bought. Decisions can happen without public panic. The goal isn't fairness, the goal is survival. The rig needs a bridge from Friday's close to Monday's open without admitting that something has broken. History is very clear on this. When leverage blows up, rules change. They changed in 1980, they changed in 1998, they changed in 2008, and they always change quietly while the sheep are distracted. That is the real purpose of this meeting. Not to stop the move, but to manage the damage. And once you get that, you realize this is not a sign of strength. It is an admission that control has already been lost. When markets lose control, stress doesn't show up first in price. It shows up in the plumbing, the clearinghouse. This is the invisible backbone of the fiat system. It backs every trade, every settlement, every promise made between counterparties. Most stackers never think about it because it is designed to be boring, until it isn't. If a major player fails, the clearinghouse eats the loss using a default fund funded by its member banks. This fund is the insurance policy, but it is built on assumptions of normal volatility. A 10% rip in silver breaks those assumptions instantly. At prices near 79, the notional exposure of short positions is massive. If silver gaps higher, again losses accelerate. They do not creep slowly, they cascade. And once losses approach the size of the default fund, the problem stops being about one bank. It becomes existential. This is why exchanges have emergency powers, margin hikes, position limits, trading halts, liquidation only. These tools are not about protecting us stackers. They are about saving the clearinghouse, because if traders lose faith that trades will settle, liquidity vanishes and the market freezes. Behind closed doors, risk managers aren't debating price. They are debating thresholds. How much pain can the rig absorb before trust collapses? How much intervention is required to survive until Monday? Every option has consequences. Every rule shift signals weakness, and every attempt to stop volatility exposes how fragile the structure really is. They are not managing a market. They are trying to keep the lights on. The next pressure point is collateral. This is where the game becomes truly dangerous. Banks don't just trade silver in isolation. Every leveraged position is backed by collateral, and most of that collateral is government bonds. Treasuries are supposed to be the safest asset on earth. They are the foundation of trust inside the financial system. But right now that foundation is cracking. Bond prices are dumping. Inflation fears are rising. Political risk is back on the table. This means the value of the collateral is dropping at the exact same time the losses on silver positions are exploding. This is a double squeeze. On one side of the ledger, banks are facing margin calls on silver shorts. On the other side, the bonds they pledged as collateral are worth less every hour. To survive, they need fiat. And when banks need cash fast, they sell whatever they can. Not because those assets are bad, but because they are liquid. This is how a silver squeeze spreads into everything else. Stocks can dump, crypto can drop, not because their fundamentals changed, but because silver losses must be paid. Liquidity is being sucked out of the system to fill a growing hole in the metals market. This is the moment where a commodity event becomes a macro event. The weekend meetings aren't just about silver, they are about preventing a liquidity crisis across markets. Risk managers are trying to ring-fence the damage to stop a localized failure from becoming systemic. But there is a problem they cannot escape. They can control paper markets. They can change rules on futures exchanges. But they cannot control the physical market. They cannot control Asia. They cannot control what happens when paper prices detach from real-world supply. If they smash the price on screens, the physical market simply decouples. Premiums rip. Metal flows east. Vaults drain. Every attempt to control price accelerates the loss of inventory. The system is trapped between stability and reality always wins. When control over price begins to slip, the next battlefield is psychology. This is where narrative becomes a weapon. Whenever emergency meetings happen, a message usually follows. It leaks quietly into the media. Calm language, reassuring headlines, regulators monitor volatility. Banks say liquidity is ample. Analysts warn of a speculative bubble. This isn't information, it is influence. The goal is simple. Scare weak hands into selling at the open. Banks need liquidity. They need someone to take the other side of their trades. And retail fear is the fastest source of supply. But this time the narrative is failing. Confidence in institutions is already fractured. Apes are no longer listening to official statements. They are watching the price. They see silver at levels that were supposed to be impossible. They see gold holding strength. They feel inflation in their daily lives. The story on the screen does not match the story in reality. When confidence breaks, words stop working. Meetings stop working. Only price remains. And price is moving in the wrong direction for those in control. The irony is brutal. The leverage used to tamp silver is now the same leverage driving it higher. The rules designed to protect the system are now trapping it. Every attempt to talk the market down confirms the problem exists. This is what system stress looks like. It does not announce itself with alarms. It leaks through disbelief, through contradictions, through narratives that no longer persuade. The market senses this weakness before the public does. This specific moment is vital. not just for the metal, but because faith is finally shifting. Once that belief turns, the market will not go back to sleep. At this phase, the question isn't if intervention happens, but how far it goes. When pressure spikes fast, exchanges open the emergency rulebook. The first tool is constant margin hikes. By raising the requirements, they aim to force the leverage of average paper specs out of the market. We have already seen this rig fail. Margins were raised sharply, yet the spot price kept rising. That tells us something key. This run is no longer driven by speculative paper leverage. The buyers standing firm are not borrowing. They are paying cash. This changes the whole game. Margin hikes crush the small specs, but they do nothing to stop industrial users, sovereigns, or corporations securing supply. These whales welcome higher margins because it shakes out the weak hands and reduces the competition. The next tool is position limits. Exchanges force holders to cut exposure via max contract sizes. On paper, this looks strong, but capital is mobile. If one venue limits positions, demand migrates elsewhere. London, Shanghai, the OTC markets. You cannot fence in a global market with local rules. The last option is most dangerous liquidation-only trading. Buying is blocked, and only selling is allowed. It guarantees a price drop, but at huge cost. It kills trust in the exchange itself. Investors do not forget when rules are changed mid-game. Every tool available to authorities carries a trade-off. Each fix protects the system in the short term, but undermines it in the long run. The more aggressively they intervene, the faster capital looks for an exit. This is why these meetings are so tense. There is simply no clean solution. Every choice accelerates a different kind of failure, and the longer they wait, the narrower the path becomes. The real constraint is not paper. It is physical supply. This is where the system runs out of room. Paper markets can be adjusted rules, rewritten screens frozen. Physical metal cannot be created on demand. It must be mined, refined, transported, and delivered, all of which take time the system no longer has. As paper prices become unstable, the physical market begins to detach. Premiums rise quietly at first, then violently. Inventory disappears. Dealers stop advertising availability and start rationing what remains. Replacement risk becomes the dominant concern. When spot price signals lose credibility, supply vanishes almost overnight. This creates a self-reinforcing loop. Every attempt to cap the paper price increases demand for physical metal. Arbitrage drains Western vaults and redirects inventory eastward. Once physical silver leaves these systems, it rarely comes back. The paper market becomes a hollow shell without substance. Mining companies see this shift clearly. They are no longer forced sellers. With supply tight and demand surging, withholding production becomes logical. Why sell real metal today at an uncertain price, when tomorrow may bring clarity at a much higher level? Strategic delay becomes leverage. Industrial buyers feel the pressure next. They cannot wait for stability. They need silver to operate, and when supply chains feel threatened, behavior changes. Companies stop buying what they need and start buying whatever they can secure. Fear replaces efficiency here. This is how shortages truly form. Not from sudden demand spikes, but from collapsing trust in future availability. At that point, price no longer controls the market. Access does. And when access becomes scarce, markets move with speed and violence that models cannot ever contain. Once physical supply becomes the constraint, the crisis moves beyond markets and into geopolitics. Silver is not just a financial asset, it is a strategic material. It sits inside electronics, energy systems, defense technology, and industrial infrastructure. When prices surge and shortages appear, governments start paying real attention. Major producing nations understand their leverage. Mexico alone accounts for a significant share of global silver output. When prices rise rapidly, political risk rises with them. Export controls, windfall taxes, or strategic reserve policies suddenly become part of the conversation. These are not radical ideas. They are standard responses when a country controls something the whole world desperately needs. For the banks, this is an unhedgeable risk. You cannot hedge a sovereign decision. You cannot model a political announcement. If a producing nation restricts exports or demands domestic allocation, available supply tightens instantly. Prices gap heavily before markets can react. At the same time, corporations are scrambling. Technology and manufacturing firms cannot afford supply interruptions. Procurement teams are no longer price-sensitive, they are availability-sensitive. Long-term contracts are signed off-market, entire future production streams are pre-sold. Metal disappears from public exchanges without ever touching the vault. This creates a two-tier market. A public price that is volatile and unstable, and a private price that is higher and opaque. Banks are trapped in the public market trying to cover positions in a pool that is being quietly drained away. This is how financial stress turns into strategic stress. The market stops asking what silver is worth and starts asking who controls it. And once that question is asked, price becomes a political outcome, not a financial one truly. As this pressure builds, something else begins to surface: failure rumors. Every crisis has a weak link that the public does not see until it snaps. Not a household name bank, but a shadow institution. A commodity fund, a trading advisor, an entity operating with massive leverage and minimal oversight here. These firms live in the gaps of the system. They borrow short trade big and rely on calm markets to survive. When volatility spikes, they have no protection, no safety net, no political shield. And when they fail, they do not ever fail quietly. Forced liquidation is mechanical. It does not care about valuation resistance levels or technical indicators. It buys because it must. When a large, short position is blown out, the covering order becomes pure demand. It chases price higher regardless of cost. This is how melt-ups are truly born. The timing makes it worse. Holiday liquidity is thin. Order books are shallow. A single forced buyer can move the market violently. This is why gaps form, not because of optimism, but because no one is willing to stand in the way today. At the same time, retail attention is waking up. Search trends rise, social feeds light up. People who ignored silver for years suddenly notice it breaking levels that were once unthinkable. But access is limited. Physical is scarce. Dealers are sold out. ETFs carry risk. So capital flows where it can move. Capital flows into mining equities. This is the path of least resistance. Brokerage apps are open. Tickers are liquid. Exposure feels accessible. And when millions of small investors move at once, the effect is explosive. Stocks that were ignored become crowded overnight. Liquidity floods in faster than fundamentals can ever adjust. This is how a metal squeeze metastasizes, from futures to physical to equities. Each layer amplifies the next. By the time the public arrives, the structure underneath is already unstable. And once that happens, price acceleration becomes self-sustaining here. We have arrived at the moment of decision. This weekend was not just another volatile episode. It was a transition point. The emergency meetings, the rule discussions, the stress, and the plumbing of the system all point to the same conclusion. The old framework is failing. When markets require coordination behind closed doors to survive, price is no longer being discovered. It is being managed. And managed prices never hold forever, ever. As markets reopen, volatility will be extreme. Gaps will form. Headlines will shift. Emotions will run high. The most important mistake investors make in moments like this is confusing movement with meaning. A sharp drop does not mean the thesis is broken. A sharp rally does not mean it is over. In structural events, price swings are noise around a larger repricing here. The lesson here is not about silver alone. It is about leverage, trust, and scarcity. Systems built on assumptions of stability fail when the volatility returns. Assets that can be created infinitely lose purchasing power. Assets that are finite regain it. This cycle repeats throughout history, and every generation learns it the hard way truly. Strategy matters now. Chasing every move invites mistakes. Panic selling rewards the very forces that created the imbalance. The strongest position in moments like this is clarity. Know why you hold what you hold. Understand the difference between paper exposure and real ownership. Manage risk without abandoning conviction today. Above all, remember this. Markets do not move to make you comfortable. They move to force decisions. Those who survive are not the fastest or the loudest. They are the most prepared ones. This is not the end of the story. It is the beginning of a new chapter in how value is measured and protected. If you want to stay ahead of these shifts, if you want clear analysis without noise or hype, make sure you subscribe to the channel, like this video, and share it with someone who needs to hear it. And leave a comment below with your thoughts, because the conversation matters now more than ever here.